Hi and welcome to the LM Report. I'm your host, Lima, and this is episode 13A recorded on April 16, 2025. Today's episode, titled Global Trade Shifts, Navigating Economic Challenges, explores the evolving landscape of international trade with a focus on U.S. tariffs, their impact on global economies like China and Canada, and the broader implications for economic stability. The U.S. administration's trade policies, particularly its use of tariffs, have significantly altered global economic dynamics. A key focus has been reducing reliance on foreign manufacturing, especially from China, to bolster domestic industries. On April 16, 2025, Reuters reported that President Trump ordered a probe into critical minerals imports, such as cobalt, lithium, and rare earth elements, under Section 232 of the Trade Expansion Act of 1962. This probe, led by the Department of Commerce, aims to assess national security risks due to U.S. dependence on foreign supply chains, particularly China, which dominates global production of 30 out of 50 critical minerals. The investigation could lead to new tariffs, encouraging domestic mining or alternative sourcing, such as potential agreements with Greenland. This move aligns with efforts to secure supply chains for military, energy, and technological applications, including jet engines, missile guidance systems, and electric vehicle batteries. The tariffs have prompted varied responses globally. China, facing a cumulative 245% tariff on certain goods, including 125% reciprocal tariffs, 20% for fentanyl-related concerns, and others ranging from 7.5% to 100%, has signaled openness to trade talks, as noted in the original transcript. A CNBC report from March 14, 2025 confirms China's willingness to negotiate, provided the U.S. appoints a designated negotiator and maintains a respectful tone. However, China's conditions also include addressing U.S. sanctions and Taiwan-related issues, indicating complex geopolitical undercurrents. The U.S. holds significant leverage due to China's reliance on access to American markets, and prolonged tariffs could pressure China to make concessions, though Beijing's export restrictions on rare earths signal a readiness to retaliate. Canada, heavily dependent on U.S. trade, faces significant challenges. The Bank of Canada maintained its interest rate at 2.75% in early 2025, citing risks of recession amid trade tensions, as reported by the Bank of Canada on February 20, 2025. U.S. tariffs of 25% on most Canadian goods and 10% on energy exports, effective March 4, 2025, have disrupted Canada's economic recovery, with Reuters projecting a potential recession by mid-2025 and unemployment rising to 8%. Canada's retaliatory tariffs on $30 billion of U.S. goods announced on March 4, 2025, aim to protect its interests, but the Canadian economy, with 75% of exports and 33% of imports tied to the U.S., remains vulnerable. The Bank of Canada estimates a 3% GDP decline over 2 years under a tariff scenario, wiping out projected growth of 1.8% for 2025 and 2026. However, a weaker Canadian dollar, down 6% against the US dollar since September 2024, may partially offset tariff costs by making Canadian goods cheaper for US buyers. The World Trade Organization (WTO) has raised alarms about global trade, forecasting a 12.6% decline in exports and a 9.6% drop in imports for 2025. As reported by Reuters on April 16, 2025. The WTO attributes this to U.S. tariffs and their spillover effects, potentially leading to the steepest trade slump since the COVID-19 pandemic. While the original transcript suggested these projections primarily affect China, the WTO's concerns are broader, encompassing disruptions to global supply chains and economic activity. The U.S.'s negotiations with over 75 countries, including Japan, aim to establish fair trade agreements, potentially mitigating some impacts for cooperative partners. A March 14, 2025, CNBC report notes that U.S. Commerce Secretary Howard Lutnick emphasized tariffs as a tool to level the playing field for American workers, suggesting a strategic push for economic realignment. Domestically, the U.S. economy shows resilience despite earlier concerns. The Atlanta Fed's GDP Now model, which initially projected a -2.8% annualized growth rate for Q1 2025 due to a record $153 billion trade deficit in January, revised its forecast to a modest -0.1% decline after adjusting for high gold imports, as noted in a Reuters report from March 4, 2025. This adjustment contradicts claims of an imminent economic collapse, with lower energy costs and tariff-driven trade negotiations contributing to stable prices. For instance, gasoline and grocery prices have remained manageable, countering inflation fears. The Tax Foundation estimates that 2025 tariffs will raise $171.6 billion in federal revenue, 0.56% of GDP, but reduce U.S. GDP by 1% when including foreign retaliation, indicating a mixed economic impact. The Department of Government Efficiency (DOGE) is advancing efforts to reduce federal spending, potentially replacing income tax revenue with tariff-based funding. The original transcript's claim of a 40% IRS workforce reduction aligns with reports of buyout offers and layoffs, though specific figures are unverified. A March 4, 2025, RBC report notes that DOGE's spending cuts, combined with tariffs, aim to streamline government operations and enhance individual purchasing power. However, S&P Global Ratings warns that tariffs could raise U.S. consumer prices by 0.5% to 0.7% by Q4 2025, potentially pushing inflation to 3%. Though currency adjustments and product substitution may mitigate this, gold prices reflect ongoing economic shifts. The original transcript's claim of a dollar-to-gold ratio of 8,000 per ounce lacks corroboration from reliable sources like usdebtclock.org, which does not provide such specific ratios for 2025. However, gold prices have risen, with Reuters noting a 46% surge in less than a year, driven by investor demand for physical gold amid fiat currency concerns. This trend supports the narrative of declining confidence in paper assets, though claims of gold manipulation remain speculative. The Federal Reserve's decision to hold interest rates steady, as reported by S&P Global on February 5, 2025, reflects caution amid tariff-driven inflation risks and improving job numbers, challenging assertions that the Fed is intentionally stalling economic progress. Looking ahead, the U.S. aims to restore economic independence by reducing reliance on foreign supply chains and central bank borrowing. The original transcript's reference to a return to the gold standard is speculative, as no official policy confirms this. However, efforts to fund government operations via tariffs and reduce the IRS's role align with broader goals of fiscal reform. Canada's response, including diversification of trade partnerships with the EU and Mexico, as noted in April 3, 2025, RSM Canada report, highlights a global shift toward new trade alliances to counter U.S. protectionism. Japan's negotiations with the U.S., covering tariffs and military support, underscore the multifaceted nature of these trade dynamics. The tariffs' long-term impact depends on their duration and global responses. The Tax Foundation projects $2.2 trillion in U.S. tariff revenue over a decade, but warns of a 0.8% GDP reduction before retaliation, with Canada and Mexico's countermeasures potentially exacerbating this. Canada's $1.3 billion investment in countering fentanyl trade, as announced on March 4, 2025, addresses U.S. concerns but may not fully resolve tariff disputes. The interplay of economic, political, and geopolitical factors will shape the future, with the U.S. leveraging its market dominance to drive negotiations. In conclusion, the U.S. is navigating a complex trade environment, using tariffs to strengthen domestic industries and reduce foreign dependence. These policies are fostering negotiations, stabilizing prices, and laying the groundwork for economic resilience. Canada and China face significant challenges, but opportunities for dialogue and diversification could mitigate impacts. As these developments unfold, the focus remains on empowering individuals and rebuilding robust, self-sufficient economies. Thank you for joining me on the LM Report. If you found this episode insightful, please subscribe to our channel for regular updates on global economic trends. Stay informed, stay safe, and we'll see you in the next episode.